Good afternoon and welcome to BizTech's Asian Midday Market Watch. Kelvin Wong, market strategist at CMC Markets, joins us today. Welcome to the show, Kelvin.
Hi, good to be back, Brian.
Now, Kelvin, we'll get a look at crypto markets and then regional stock markets, and then go back to you and get your insights. We start with Bitcoin, which is at 42,874. It's up 2.24%. Ethereum is at 3,021.45. It's up 2.92%. We look at regional stock markets now, and we start with Singapore. The SGX is at 3,391.09. It's up 0.8%. The KLSC is at 1,595.64. It's down 0.14%. Shanghai is at 3,253. It's down 0.55%. The ASX ordinaries closed at 7,680.5. It's up 0.2%. The Nikkei is at 27,986.5. It's down 0.21%. The Hang Seng is at 22,213. It's up 0.27%. And rounding up the numbers, we've got the Kospi, which is at 2,721. It's down 0.48%. Kelvin, what's your view on market performance this morning?
Yeah, so if you look at as a whole, as a backdrop as a whole, it seems to me it's pretty mixed for Asia stock market. So given that last night, US, the major indices in US have started to shape that pullback after we call it a series of more hawkish Fed speak for various officials. But what's interesting to look at from a Asia market perspective, you start to see a kind of a very startlingly outperformer in the Singapore market. So you look at the Straits Times Index is actually up 0.8% now, due to the fact that just a while ago, 2 hours ago, Singapore leaders actually made an announcement that we're going to further ease off our current COVID-19 restrictions, which i.e. we are talking about more traveling, more events that to actually take place, and also easing off of various COVID-19 like mask on restrictions. So what we could see over here is that we start to see outperforming stocks related to travel and leisure, such as the Singapore Airlines and Genting Singapore, which is the casino operator. Both of them are up close to about 3.9% and 3.2% respectively now. So that's actually the key catalyst that's really driving the current outperformance that's been seen in the Singapore stock market against the rest of the ASEAN region.
Now, we move on to Fed speak really over the last couple of days. That's really, besides the Ukrainian crisis, really dominating investor thinking and fears. What's your view on now the view ahead in terms of the hawkishness of the Fed?
Yes, precisely. So before we talk about how its implication of the markets first, let's take a look at what the narrative that started at the start of this week. So this Fed speak actually kickstart off with Fed Chair Powell. He actually made a public speech in one of the economic event that he's actually in favor of a 50 basis points hike. In a way that he said that he cannot rule out that this could be a possibility in the next May meeting. So that actually tone was actually much more hawkish during his prior week, which is the post FOMC press conference. Then after his hawkish remarks, a couple of series of Fed speakers also came out. We have Bulan, which is traditionally known to be a hawkish, then followed by a couple of three or four more officials. Most of them are actually voting members of the FOMC committee. That means they have actually a say of to dictate the federal Fed funds rate in terms of their vote. So all of them seems to be pretty much in favor of a 50 basis point hike in the next upcoming meeting in May. So with that, we call it a hawkish rhetoric. We start to see a shift in the probability as being priced into the Fed funds futures market by this CMA Fed Fund Watch tool, which I'd like to share with the audience over here.
Okay.
So let's take a look at this. So what we see right now over here is this is the current expectation of where the Fed Fund will be in after 4th of May. That means after the next FOMC meeting in 4th of May.
Okay.
So 50 basis point to 75 basis point implies a 25 basis point height. So if you look at the probability right from over the weeks, right, all the way it starts to decline. So right now it's just showing a probability of 33.9%. Okay, remarkably previously for the week of this, yeah, so about a week ago or so, or a month ago, it was actually at 44%. Okay, then what if you compare to the next we call it based the next rate level, which is 75 basis point to 100 basis point. So that actually imply a 50 basis point hike from the current rate. And if you look at the
Okay.
increase in the probability from a month ago, which is 44%, to the current level, which is now at 66%. So we start to see a stark, we call it increase in the expectation of a 50 basis point hike in the Fed Fund futures market, as implied by the Fed Fund futures market. So markets now actually are getting pretty much in tune with the hawkishness that's being portrayed by the Fed. And now the next question we'll ask ourselves: how does it imply to the financial market, like for example the U.S. stock market as per se? So if I look at the US stock market right now, by taking into the comparison of this particular chart, it's a bit complicated. Let's take one step at a time.
Mhm.
Let's look at this red line first. So this red line, right, is actually the differential between the US 10-year minus the US Treasury 2-year. So we call that the yield spread. Okay, so if
Yep.
you look at the yield spread, right, it's been declining pretty dramatically since 15th of March last year. And since the start of this year, it actually did another round of steep decline over here. So what we could understand, or what it could actually imply, telling us that actually now it's actually quoting at 0.2%. So what it means over here is that given the current hawkiness or tone that's being detected by the Federal Reserve officials, we are looking at the shorter term yield that is rising as a faster speed or faster gradient or magnitude compared to the longer term yield, which is the 10-year. So that's why the levels are getting smaller and smaller. And if it starts to go below zero, that means we're talking about yield curve inversion. So once this yield curve inversion comes, it actually implies one day it gives us a bit of a head start, telling to us that there is a high probability that the US economy may start to hit into a recession. So what it means over here is that there's a potential probably that what the Fed is doing right now is actually triggering off a slower growth environment for the US economy. So if that's being said, the case over here is that there are certain stocks, right, that will actually perform better in this particular environment. And very clearly is that the stocks that actually performing well right now is the energy, which is this purple line over here.
Mhm.
Energy, it's an ETF, so it's a energy ETF. So
Right.
it's basically just taken as a basket of energy stocks in the US, listed on the US stock exchange. They're actually performing exceptionally well since the start of this year. So what it means that over here is that, hey, there's a possibility that this is all related to higher oil prices and higher inflationary pressure. So people are going to this energy stock as a hedge over here. So what it means by this flattening of this US 10-year minus 2-year treasury yield curve is that the Fed probably will have engineered potentially a slower growth environment in US. But however, will this lead to a soft landing? It seems to me that the market doesn't believe this right now. Why? Because if you look at other growth related stocks or the ETF as per se, like the information technology, it has been coming down since the start of this year,
Yes.
in line with the in line with this year potential yield curve invasion that is taking place. So we're talking about the market doesn't seem to be perceived that the Fed is able to achieve a potential soft landing by their current, we call it hawkish, we call it stance. And what's interesting over here is that even the banks and financials, they're actually starting to underperform as well. If you look at the blue line and the orange line, they're just sloping, the trend is actually sloping downwards since the start of this year. So this telling us that over here is that, hey, uh, we call it stocks that are related to growth. Well, banks is still also related to growth through their
Mhm.
loans and through their capital markets operation, as per se, for some of the investment banks. It seems to me that a lower, we call it a potential yield curve flattening or yield curve inversion doesn't bode well for growth related stocks. However, uh, stocks that are related to this inflationary play right now is actually outperforming as a hedge. And what's interesting over here is that I want to take a look at another one, which is this turquoise blue line, which is the utilities. The XL utilities is so performing relatively well. And what's interesting over here, since February, it started to move pretty much in terms of magnitude in line with the energy stocks. So telling us that utility tends to be a bit of a defensive nature. So what we could
Okay.
see the market is actually portraying a bit of a hesitance to actually take on more, we call it higher beta or more pro growth related stocks. They are shifting more their focus or allocating their what you call it, their weightage more towards a defensive play, and as well as a place that could actually give them a hedge with this heightening inflation pressures that it seems to be still persistent in the marketplace right now.
Now, Kelvin, thank you very much for your insights. This has been quite fascinating.
Thank you, Brian. My pleasure.
Now, we've been speaking to Kelvin Wong, market strategist at CMC Markets on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.
Thank you.